I'm Adam Myers. I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Steve Black, the co-portfolio manager of the Pengana Emerging Companies Fund. From a format perspective, I've asked Steve to keep his prepared section reasonably short so we'll have plenty of time for Q&A at the end. So please, any questions that you have about the fund or the investment environment or specific exposures, please enter them into the Q&A box, which can be accessed from the icon on your screen, and hopefully we can have a really interesting conversation at the end. Steve, over to you.
Thanks, Adam, and good morning, everyone. So on this introductory slide, I won't labour the point, but for those that are new to the fund, this is a fund that's 18 years old. It's an industrial-only fund, and it's managed by Ed Prendergast and myself with over 50 years experience. So critical to how we think about the investing is that alignment of interests. So Ed and I are co-owners of the business, co-unit holders of the business, and that's really a key theme coming through to, I think, why this fund has performed so well over the last 18 years, delivering a return of circa 12% per annum after fees. So it's fair to say that we've seen all market conditions over those times, and these conditions are clearly quite trying, so I'll touch on that briefly shortly. And that disciplined investment approach, which is very much focused on assessing companies' risk bottom-up, is paramount in this market. It truly is a stock-picking market. Which is the next slide. So this is the 18-year journey, averaging 7.1% per annum performance after fees against the Small Industrials Index. And as you can see, I think probably the two takeouts for me are the consistency of outcomes over all market conditions. And probably just to call out that the one market that doesn't necessarily suit us in the short term is the highly a very large fall in the market, where what happens is you get a risk-off mentality and investors choose not to invest in companies that are illiquid. So by definition, we are operating at the most illiquid end of the market. We've got 800 stocks to pick a 60-stock portfolio on, and many of those stocks aren't in the index, that they're illiquid. So if markets fall sharply, we tend to underperform a little bit, but then we take advantage of those stocks being wrongly oversold, and that's led to some very strong outperformance out of the GFC period you see there and out of the COVID period, and hopefully again out of the current inflation-driven period. Pleasingly, we've also generated those returns by taking less risk than the market. So this chart just simply tracks when we perform, and we've outperformed in up markets, but we do a whole lot better when markets are falling. And that's because of that very disciplined, risk-based approach to investing, and also not owning the more speculative end of the market, being the small resource stocks and loss-making stocks, some of those high-flying tech stocks. So that's a pleasing outcome for investors. Just moving now over to valuations. And suffice to say that we know that the world is very turbulent at the moment. I've got no idea which direction markets are going, and that's why we always stay fully invested. I think that's a quote from John Galbraith, who's the famous economist that resides in North America, sums up our view. It is very, very difficult to predict markets. Some of the best brains in the world are attempting to do so, and it's just fraught with danger. You can undo a lot of very good stock picking by just getting the market direction wrong. And you can see on that chart on the top right there how asset allocators are feeling about investing in the US. This is just tracking balanced fund asset allocators, and we're at a 22, 23-year low as it relates to their degree to which they're invested in equity. So our view would be simple, and take a long-term, well-thought-out investment approach, remove the emotion. Now seems like quite a good time to invest, given the concerns that are in the market. Sure, there is a lot of worry out there, inflation, China, Europe energy shocks, and all the geopolitical risks, but that's why markets are trading where they are. And then just a reality check on that bottom right-hand chart there. In 100 years, if you look back, there's only been 3 occasions where the subsequent 10 years of performance would have been negative for you when investing in the Australian equity market. And that was during the Great Depression, oil crisis, and GFC. So you would have been very unlucky to invest just before those periods. It tends over a long period of time to perform very well for you. Just moving away from markets and more looking at the end of the market we operate in. We're obviously looking at small industrial companies. Probably the one end of the market we'd still be quite cautious about is the high growth end of the market, or the stocks that the frothiest, more speculative end of the market. Top chart there is tracking the enterprise value to sales ratio of the top 40 companies in the Australian market. We obviously use enterprise value to sales because half those 40 stocks are simply loss makers. So there's no earnings to put a P over to get a PE ratio. But it's more just the barometer of how the market's looking at high growth stocks at the moment. It's obviously retraced from where it was, but potentially has further to fall if it's to normalise to longer term averages. And you can see in the far left there the dot-com boom and subsequent bust took a couple of years for that to unwind. So this is not the end of the market we would ever invest in. We're not that high growth, loss-making end of the market, but as I say, it's a barometer, I think, of how the mood of the market has changed. What we do invest in and have invested in, but not right now, are those bottom three stocks. So ARB, Lovisa, Breville, they're really pin-up stocks for the small cap end of the market. We'd love to own them again, but our view is that they just haven't fallen far enough. So we'll be prepared to be patient and greedy and wait for those stocks to fall further before we enter into those, given the nature of the market, which is now obviously with interest rates higher, long duration stocks are less attractive. So wrapping that up in a portfolio positioning sense, that pie chart maps out how we're positioned. Defensive stocks for us is where companies' earnings streams aren't reliant on the economic recovery, or they're not linked to the economy. They're not going to be buffeted by a downturn necessarily. So examples of that would be healthcare stocks, insurance brokers, funeral home operators. They're really good franchise businesses where we don't have to worry so much about how the economy is going to behave next year in a high inflationary environment. Probably the other quick observation from that this page, I guess, is that the average PE of the portfolio, the top 10 holdings, is 16.8. It was 23 12 months ago. And that's because last year we sold a lot of investments in our fund that were hitting our target valuation. So we need to be disciplined in a sharply uprising market last year where the fund performed very well. That did realise a lot of capital gains, which also meant we had larger distributions at 30 June that existing investors would probably be aware of. So just turning now to a couple of stock examples. And this is a really good example of a stock we'd love to find. IVE Group, it's not necessarily operating in the world's most exciting industry. It's a marketing company, quite a low growth industry. But if you peel back the covers and look at what is on offer as an investment proposition, you find a company that's trading on under 7 times PE, sustainable dividend yield of 10% fully franked. They're mission critical to their customers, and that's evidenced by the fact that the top 20 customers, they've had those customers for on average greater than 10 years. And there's very little broker coverage. So when they bought out their largest competitor, Avato, which recently was in the hands of the receivers, and now they no longer have a large competitor, there was very little coverage of that in the marketplace. So we expect that the stock will do very well, and it helps explain why it's still trading on what is a very modest PE ratio. And then secondly, Propel Funerals, a long-standing holding of our fund, performed obviously very well, and it tends to deliver about 15 to 20% profit growth per annum through both organic growth, but also through acquisition-led growth. So the funeral home industry is a very fragmented industry. The management team have proven in this space in terms of previously rolling up or corporatising the sector through a company called Bledisloe, which they then sold off to Invacare in 2011. They put the band back together and listed this company about 5 years ago. And as I say, now they have about 5% of the market, still very long run rate for growth. So we're still very excited about the prospects. And then just to finish before we go to Q&A, just looking at the top 10 holdings of the fund, and just a little bit of flavour there for the type of stocks that we like to own, and also with the PE ratios there, you can see the growth that we're forecasting into 2024. So with that, Adam, I'll hand back to you for any questions.
Great, thanks, Steve. I'm just looking at the questions now, and we already have a lot of questions that have come through. First question, learnings from the reporting season. Are you seeing signs of stress? And if so, is it concentrated? Are the interest rates rises already starting to bite?
Yes, I think it's fair to say the reporting season that we've just moved through, and Ed and I will have met 50 to 60 companies, is probably less relevant than the normal reporting season because they're reporting on a period of time that was actually quite buoyant. Coming out of COVID, there was a lot of sort of pent-up demand, a lot of normalisation of earnings off a low base. So you saw good growth. So we're probably less focused on what has transpired and more focused on the future, to your point. But the effects of inflation and the necessary increase in interest rates is really yet to play through. What is interesting though is with the AGM reporting season, we call it reporting season because a lot of these companies are now providing market updates on how they're trading. We're already seeing some really quite concerning trends with regards to demand falling away a little. Cost of sourcing product into Australia with a low Aussie dollar against the US dollar is really starting to pinch margins. Baby bunting is one really good example of that recently, and the share price has fallen a lot. So we're quite measured and recognising that we deploy a bottom-up stock selection approach. So we value every company on cash flow. There's a fair degree of subjectivity, more so than normal, that must be used to arrive at your inputs given the state of the current market. So it helps explain why our defensive position of fund is a little higher than normal. And also with inflation, we've really spent a lot of time looking at the makeup of the portfolio to ensure that the companies that we do own have the necessary pricing power to pass on those cost increases coming through. Or indeed have terms in their contracts that allow them to automatically pass those through. So, and where that's not the case, we've shipped out some of those companies to the fund, and we've moved in some good inflation hedge stocks like Metcash, Calcium will be two examples that come to mind.
Great. So you just made the point that you guys are bottom-up stock selectors, but the market at the moment is largely being driven by top-down factors. So where does that leave you guys at the moment?
Well, it's a very good observation, and we're certainly in our DNA. We're programmed to think out 10 years. That's how we model every company. But the market's obviously quite skittish at the moment in terms of which way, where inflation is going to track, which is probably the major determinant of the skittishness. And I mean, there used to be 2 or 3% moves in markets used to be rare. They seem to be every second or third day at the moment, which is, I think, a reflection of that no one really understands how this is going to play out. So we're not top-down stock pickers, nor are we economists, but I am a little concerned about how sticky inflation is. And once it becomes behavioural in terms of corporates expecting inflation, employees expecting inflation, then it's built into pricing structures. And that's very, very hard to unwind, which is clearly why the reserve banks around the world are all aligned, in particular the US is very aggressive on this in trying to tame inflation, get ahead of the curve, so you don't get a late 70s type of outcome. So we're looking at it more from the perspective stock by stock. As I said, where a company we feel is a price taker and can't pass on cost increases, we'd be quite concerned in this market. Certainly, you're certainly not being paid to take that risk anyway, because some of those stocks are still trading at very high prices. And even the retailers especially retailers would be a good example of that, where they really don't have a strong ability to pass on cost increases, particularly if a slow economy is slowing. So case by case, and just be mindful that We're not going to take market risk. We'll stay fully invested. As I said, I think that's a very dangerous proposition, but no, stock by stock, we'll ask the questions. We need to ask management and make sure that there's protection against those cost increases. And the recession, which is for many forecasters is now a near certainty, is something that another reason why you'd want to be careful in owning cyclical stocks at this moment.
So you mentioned Propel Funerals, which is a great example of a company where the demand doesn't deviate much. And you mentioned adding to Metcash. Are there other examples of industries and companies that you think are well placed in the current environment and potentially for the foreseeable future?
Yeah, so it's certainly the stocks where you have, as I said, you have terms in the contract that allow you to pass on those price increases. So Kelsian would be another one, which is a busing and tourism business. The tourism assets are unique, so you can pass on the cost increases quite easily. And the busing contracts are with the governments, where you're paid on a sort of route by route basis. It's less about number of passengers or indeed the price you need to charge those passengers. So they'd be two examples of that. And then indeed, it's also in a valuation perspective, inflation is causing high interest rates, but it's also causing high discount rates. So we need to be careful that in this changing world, that we reassess the valuations of the higher growth stocks in the marketplace, because we've had 10 years plus of falling interest rates, which has really fueled those long duration cash flow businesses with a low discount or a falling discount rate. Shorter duration businesses, in other words, companies on low PE ratios, are certainly more attractive to us at the moment in this marketplace. And IVE Group is a good example of that, where sure, it's not the world's best industry, but if they're a dominant player in that industry, and it's on a P of less than 7 times in an uncertain world with discount rates rising, that for us is quite appealing.
Makes sense. Sticking with sort of the stylistic questions for a while, not investing in resources has obviously hurt your relative performance this year. Have you considered investing in resources? Maybe you could explain your thinking there, and also if there are other sectors that you guys exclude.
Yeah, so now philosophically, we chose a long 18, 19 years ago now, we chose to exclude resource stocks from our investable universe. And why is that? Well, it simply came down to the fact that Ed and I had been in and around all industries except resources. I think resource sector requires a very specialist skill set. We are spoiled for choice. We've got 800, 900 stocks to build a 60 stock portfolio, and we don't have to introduce that uncertainty or risk to our approach to investing. So we'll stick to what we know, where we think we can add value, and where and so we'll continue to look at industrial cash flows with quality management teams, which we'll back with and gain that rapport and understanding of the direction that companies looking, those management teams looking to take their companies. So with resources, my view would be that they're more speculative, because, to be frank, a lot of their success is going to be coming from exploration programs and commodity price movements, which are very volatile and uncertain. The strength of management almost takes a back seat to those outcomes. So we, and a lot of people probably don't appreciate that in the small resources end of the market, around half the companies don't make money. So it's a very different end of the spectrum. Small resource companies versus large resource companies, where you've got BHP and Rio, for instance, that have very diversified assets globally and across different commodity groups, vis-a-vis these small resource stocks, which are largely exploration-driven businesses that don't make money and hope for an exploration success. So it's a loss-making approach, a lot more speculative. It's not suited to our style, with defensive style. And then it's exactly the same reason why we don't invest in loss-making companies. If we're going to hang our hat on being able to value cash flows and model cash flows over time, and that's a lot harder to achieve when you have a business that hasn't a cash flow to start with, and you haven't got a base from which to build a model. You're having to speculate a little bit on how they're going to commercialise the particular business model they have, and that'll be my concern with some of the tech companies that have listed in the stock market over the last 2 or 3 years, where they have a plan, they burn cash, then they need to continue to raise equity to fund that growth aspiration, but there's no real clear path to profitability for a lot of these tech companies, and that rings to me like it's a reminder of what happened in '99 and 2000, where the dot-com boom and bust led to a lot of these household names in small cap land effectively going broke because they were no longer able to raise equity into a sharply falling market, and that sort of has that eerie feeling about it again at the moment. So we've never wanted to invest in those loss-making companies for those reasons as well.
Over the last couple of years, certainly towards the late stages of the bull market, we saw a mad flurry of IPOs. Many of those companies had a lot of the characteristics that you have just described. What has happened to IPO activity this year? Has it dropped off a cliff completely? And if there is anything happening, have you seen anything interesting?
Well, it's certainly dried up for sure. Yeah, the deal flow is less, which shouldn't surprise anybody. The IPO window generally is open when markets are buoyant, because you take on board a lot more risk buying into an IPO than an existing listed company. So when risk is on, people turn a bit of a blind eye to perhaps some of the investment risks with a new company coming to market. But that's obviously changed this year with markets behaving the way they have. So the last cohort, which we will always meet these companies, industrial IPOs coming to market, even if they're loss makers, because you never quite know the direction that company's about to take. And we'll build up a rapport with management teams nice and early. Also, there's never, our adage is an hour with management of any listed company is never a waste of time, because you'll always learn something about an industry or a competitor that you can use. So we take those meetings, and I think over the last 2 or 3 years, last time we looked at numbers, there was 50 to 60 companies that we saw that came to market, and 2 or 3 only of those we invested in because of our concerns about buying in at the start of a listing process. Now, what we do tend to find is, notwithstanding the fact that it's a bit of a graveyard buying into companies when they first list, that 2 or 3 years down the track, after which time, we've had more time to catch up with management. The accounts have been audited year after year, lodged the ASX under their regulatory regime. We've got more confidence in the underlying results rather than numbers that were sort of stitched together for a pro forma IPO forecast. The 2 or 3 years on, there can be some really good ideas there. And examples of that might be Unity Group or Johns Lyng Group. They've been some of our better performers over the last 2 to 5 years. But having just moved through that exercise, Adam, we've unearthed very little. Unfortunately, a lot of those companies were just traded. Either they were loss-making companies that continue to be loss-making companies, or they were just priced wrongly at the time of the IPO, in the sense that the markets were so buoyant that the promoters and vendors selling out were able to fetch a very high price, which hasn't come back far enough for us to get excited. So yeah, it's always a watching brief, but it's not. There's not a whole lot of excitement there for us at the moment.
Great, thank you. I'm now going to move on to some stock-specific questions. There are always a bunch of people who join this webinar who look at your portfolio very closely and are interested in the performance of the various companies. So first question, have you been adding to your CCX position, and what are your current thoughts on the business? Will you push for a significant buyback of shares once the inventory position has normalized?
Yeah, interesting first question. CCX is probably an example of where, we'll put our hand up and say we get stock calls wrong all the time, and that was a disappointing outcome for us, CCX. So we first bought into City Chic about 5 years ago. For those that aren't aware, it's in the plus-sized women's wear category globally, and they've moved from a sort of a traditional bricks and mortar retail business to an online business, and by not just through their own growth, but also through acquisitions of other businesses that were in that space. So today, only 15 to 20% of their revenue would be generated through bricks and mortar. So it's a company that, for those that aren't aware, has share price has fallen probably 60, 70% this year. It's a stock at the interim result back in February, we were a bit concerned about heightened inventory levels, which your question there, Adam, alluded to. So we did sell a chunk of shares, not enough, but it has continued to disappoint. They've lost their CFO. We're moving into obviously a slowdown in economies, which doesn't necessarily suit demand for their product. It's somewhat discretionary. And so accordingly, in that environment, particularly also being in an online business, which is derated in a more of a market sense in terms of what investors are prepared to pay for those businesses, that's led to that unraveling of the share price. But we sit here today, and it's a company that is still very, very well run by Phil Ryan, the CEO, a bit of a veteran in the field, and trades on a PE of about 9 or 10 times earnings with very exciting growth prospects. So it's not without risk. There's a lot of moving parts that we need to allow for in building a model for this company now. And that necessitates us keeping the weight low in the portfolio. And to put that in perspective, it's 0.5% of the fund. So what it does demonstrate, City Chic also, is that we will allow for risk in our weight setting for companies. So despite the share price falling, and despite the relatively low PE, we do recognise that there's a lot more. We're a lot less definitive on terms of our ability to value that company, given the state that it's in and the economy that it's selling into, and so we'll allow for that in the weight of the stock in the portfolio. But certainly, it's a low conviction stock, not necessarily because of the management or the business, but just to the economic times that we're in.
Right, makes sense. Next question: How do you think the influx of capital into lifestyle/over 50s communities will impact on LRC in terms of an erosion of their competitive advantage?
Yes, so lifestyle communities, those that are aware, is an independent living village or community, and lifestyle communities started with these, rolling out these communities probably a good 15 to 17 years ago, and they these days roll out 2 or 3 per annum. It's one of the best businesses that we've come across, in the sense that it's truly an annuity earning streams, because they take the rental stream of which the house sits on. So the retiree coming to the village owns the house, lifestyle owns the land, and so you've got this continual annuity flowing to them. And then they sort of roll out these stores cookie cutter like. It's just a very simple model. Every year they roll out 2 or 3 new communities, and that has so the question specifically, we see a very long runway for growth for those communities. That we get concerned with companies where small caps in particular, where they can hit a glass ceiling and they take on extra risk by going overseas or into a new product range, somewhere, an area of the market they're not proven in. Well, for lifestyle communities, they're not even leaving the state. They're just Victorian based. They land banking a lot of sites for future communities to roll out. So despite the fact that Stockland and there's a few others that are moving broadly into the space, some of them are more nursing home focused rather than just retirees. But despite there being a few moving into the space, we're not overly concerned because the aging population, the demand for their particular communities is so large they can't meet that demand at the moment. So we've got a high confidence in the next 5 years plus they can continue to roll out 3 communities per annum.
Great, thank you. Next question, and apologies for keeping on using the stock codes. People tend to ask questions with stock codes. So potentially, because I don't know them all, you could just tell everyone the names of the companies as well. How big a business do you think PFP could be over the long term, and what are the biggest risks to execution?
So Propel Funerals, when they listed in 2015, were 1% of the market. Today, they are 5% of the market. Around half of that market share gain has been through Invacare. They've had a few woes, and the rest of the growths come through other smaller players outside Invacare. So, but it's still a very, very fragmented market. So Invacare has about 30%. So together, the 2 large corporates in the space are 35%. There's still a 65% to go after. So, and without any obvious anti-competitive sort of headwinds in terms of what they can take on. So we think they could continue to grow 20-25% for quite some time. That's been their average earnings growth since they listed. And whilst we're concerned with any acquisition-driven business model, the management team here, as I said earlier, are proven in the space in terms of growing businesses inorganically before they came together to set up Propel Funerals. So it's clearly the most defensive business you can find, and they have very good pricing power in the market in terms of inflationary concerns at the moment. And they released their result, or first quarterly result of the AGM last week, and that was in very much in evidence their ability to pass on cost increases and grow their business strongly. So no, it's that's certainly not a problem for them in the short term. We could happily see them rise to 15%. They could double the business without any problems, or triple the business.
Great. What are your thoughts on PSR's insurance JV with AUB? Do you think over the longer term the businesses could merge?
So I missed the last end of that question, Ed, that they could.
Do you think that over the longer term the businesses could merge?
I'm not so sure about merging. We don't spend a lot of time thinking about takeovers or mergers because that's for us down the realm of speculation. But in terms of the acquisition model of both AUB and PSI have in the insurance broking space, they've proven at acquiring these smaller businesses. It's a little bit similar to the Propel story, really, where we're happy to back companies that have a proven business model of acquiring and AUB have been doing that now best part of 16, 17 years with great success in terms of how the share price has performed. The market's a little bit sceptical with regards to their recent entry into the UK, it's fair to say. And moving in particular away from the retail broking into sort of wholesale and underwriting. But we've been long-standing shareholders in PSI, and they've certainly we've learned a lot about that wholesale end of the business, and it's not of the same quality as retail insurance broking, but certainly we understand the risks. We've allowed for those risks in assessing our position for Ausbroking entering the UK space, and we find it very exciting at these share prices. It's one of our top 5 holdings.
Great, thank you. Going to New Zealand for a moment, have you looked at New Zealand media, NZM, and do you have a view on that?
We haven't looked at it for a while. We'll look at all companies, all industrial companies. Last time we did look at it, we found that it was not just I guess an industry that was in decline, structural decline, but there was, but also just because the New Zealand economy seems to be a bit more volatile than the Australian economy, and being a cyclical company, we were just a bit concerned about the near-term earnings, and that's probably no different to now. New Zealand tends to have higher highs and lower lows as it relates to the state of their economy, and coming into what is clearly a clear an economic backdrop for New Zealand and globally, we'd be a little bit wary of companies that are reliant on the economy at the moment. So it's probably one we're due to go back and have another look at. Haven't looked at it for a couple of years, but that was some concerns we had 2 or 3 years ago.
Cool. Understood. And just taking a step back, given the positioning of the portfolio, given your investment style, is there an environment now in which your fund would really thrive? Do you see a sort of a line of sight to significant outperformance as we saw a year or 2 ago? And if so, can you sort of describe that environment?
Yeah, well, I think I think this is truly a stock picking market because there's so much uncertainty there. There's so many variables at play, stock by stock. I don't think themed investing works in this market in terms of a particular sector to target, or momentum investing or investing in tech companies. It's very much it's a company by company, understanding the risks, company by company, bottom up type market in terms of the value proposition. Because what we do know with investing in small caps over the last 25 years, it's often the stocks you don't own that determine whether you perform well as a fund manager. And so I'd be a little bit mindful of that, given the volatility of earnings flow, earning streams in the next 12 months and cost increases coming through, that the sort of blanketed approach to investing that may have worked in the past be again deployed. It's not like that. So we're excited by the fact that we have a retail only investor base. So it's sticky money. Our investors understand ups and downs in markets and volatility and aren't afraid by it. And with knowing that, we can invest with confidence in these companies that have been indiscriminately sold in really good businesses, but potentially just oversold because of the fact that they're relatively illiquid in terms of the shares that turned over the marketplace. So as Li illustrated before, out of GFC, out of COVID, it was some of our best periods, and I think it's because we were able to take advantage of that selling by others, and where these share prices were trading at the wrong prices, that we could sort of put more money to work. So another way to answer it is that in normal markets, because we're a DCF-based house, so we model every company on cash flow valuations. In a normal market, we look for 30 to 40% upside for a stock to be included in the portfolio. When markets get sold off like this, the hurdle to get into the portfolio, our 60 best ideas, becomes closer to 50%, 45, 50%. So we're seeing a lot of upside, and we're really excited about buying some of these stocks like IVE Group and PROPEL with some really good businesses that have been indiscriminately sold through no fault of their own, just because they're relatively illiquid in the marketplace. So it's a good market if you understand risk, and you can invest with confidence, knowing that you haven't institutional money that's going to be taken away from you, or you have to keep cash levels high to fund potential outflows.
I think those are some really key messages. So thank you for making those right at the end. In the interests of time, there are still a few questions, but in the interests of time, we are going to wind up at this point. If we didn't answer your question or a version of your question, because a lot of the questions were quite similar, so I probably didn't phrase them exactly as you had asked them, then we will respond to you directly. But they were really great questions, so thanks to all who submitted them. Our next webinar in the series is next Tuesday at 4 p.m. with the managers of the Pengana Alpha Israel Fund. This is a wholesale-only fund that invests in some of the sectors that are typically not available to Australian investors, so you can register for that on our website. If you have any other questions, please get in touch directly. We'd love to hear from you. Thanks again and enjoy your day.